Hey there, Dan Martell here, serial entrepreneur, investor, and creator of SaaS Academy. In this video, I'm going to share with you the options that you have to fund your SaaS business, your software as a service business. Many of them you've never heard of, and the key is to make sure you do it without giving up your business. Equity is the most valuable thing you have in your company, especially if you're going to build a successful business. You want to make sure you protect that. Be sure to stay at the end. I'm going to tell you how to get access to an exclusive resource on the 6 different models for fundraising, as well as the 11 different sources. I'll share with that more in a little bit, but let's get started. So one of the privileges that I have of coaching some of the fastest growing, incredible human beings and very driven entrepreneurs is that they're always looking to fund their growth. They're always asking themselves, how do I deploy $1 of profit or funding to generate $1.50 in increased revenue? So recently I was working with one of my clients, Mark. They were at about $1 million in ARR, annual recurring revenue, and they were evaluating different options. At the time they thought, line of credit, maybe VC, and I walked them through the other options. Most people don't realize that at a high level, I think there's about 11 different funding sources, things that you may have never heard of, like a SEAL, so shared earnings agreement, L, I forget what the L stands for, or RBF, revenue-based financing. There are so many new, what are called alternative funding sources available to founders that he went from struggling, trying to figure out the right way to grow it, to eventually closing on about $750K in funding that was non-dilutive, meaning that he didn't have to give up any equity in his business, and it allowed him to grow to the next level without having to raise venture capital or just wait and do it off of profit generated from the business. And when we look at time value of money, there's value drivers and value detractors. The equity in a SaaS business is the multiples, right? On the low end, 2x annual recurring revenue. On the high end, it can be 7 to 10. I recently had a client exit their business for 10x on 1.5 million in ARR. So $1.5 million in revenue, they sold for 15 million as an outcome, a total kind of like deal size. And I just think that's the opportunity of getting your funding sources right. So let's dive in. Number one, examine your exit. The first thing I always do with my clients is figure out, where do you want to end up? What does your exit look like, or what I call a perfect exit, right? Typically it's either get acquired by a strategic, go public, or exit the business and hire a CEO to run it and keep it as an annuity, right? Because SaaS businesses, software as a service, they're incredible because they keep paying dividends month over month if we build the business right. If we have a key demand gen process, a way for converting that demand into customers, and retaining those customers over the long term with a low churn and high expansion revenue. Not going to get into that, but understanding your perfect exit is key, so that we can figure out what that number needs to look like, because there's different standards for multiples, and then we can figure out how can we get there faster by raising capital, and how would we deploy that, and what are we willing to give up to get that capital. Right? If it's a winner-take-all market, then maybe venture capital makes a lot of sense. If it's a niche workflow kind of industry, then maybe we want to look at some debt financing partners or some revenue-based funding. But number one is figure out what your exit looks like. Examine it. Number two, map growth engine. So it is critical for you to understand your unit economics of your business. So what I mean is, can you tell me what your CAC is, your cost to acquire customers? Can you tell me what your payback period in regards to lifetime value, LTV? How quick can you pay back the cost to acquire a customer? And the true CAC, a lot of people don't consider, sales commission or even office space. Anything involved in acquiring customers should be part of that CAC. And really your churn numbers, and churn by different plans, and expansion revenue. What's the the upgrade or downgrade cycle for your product? But truly understanding your numbers, because if you want to go look at some of these alternative funding sources, they are going to ask you of this. And one of the biggest determining factors is how well you as the founder can communicate and understand your own unit economics of your business, so they can get a level of comfort to lend you money to help finance that growth. Number three is evaluate options. So as I mentioned a few times, there are several different funding sources, from friends and family to revenue-based financing to SEALs to VC to debt equity, etc. And the key is to just evaluate each one. So I mentioned below, there's a link you can click to download a copy of my funding evaluation cheat sheet. But what I say by evaluate your option is just making sure that you don't hone in on one, right? So whatever you want to do, you got to get the business ready, you got to understand the vision, you got to understand your unit economics, but then it's to go evaluate different ones. Maybe go talk to the bank and see if they're willing to write a line of credit with no security. Maybe go talk to one of these RBFs, revenue-based financing companies, or maybe talk to some VCs and see if they have any appetite. And it doesn't mean you're officially raising, you're just saying, look, we're at an interesting point where we're trying to fund our growth, we're evaluating different options, I just want to have a conversation. But to me, not knowing that, not looking at it, not even understanding the 6 models for funding. So as I mentioned, they're all linked up in the download below. You can go grab a copy, but I have 6 different models of funding, from bootstrapping to VC or private equity, etc. Or maybe it's VC to VC to VC to public offering. There's essentially 6 different patterns that most software companies go through to fund their growth, depending on the outcome they're looking to achieve in the market that they're in and the opportunity. So it's really understand just to evaluate them and not get what I see too often is like, oh, I'm doing a venture round. It's like, okay, you can do that, but did you know that there might be a different path that will ultimately, if you raise some debt capital, you can get to a higher level of revenue that will give you a better multiple, which means you're going to give up way less equity to raise that total amount of capital without by doing this debt equity financing up front. So there's a bunch of different ways to look at it, and it's just key to evaluate your options. Number 4, calculate the costs. Now, I'll be the first to admit that it is very tough for you to calculate what's called the total cost of the funding source, the capital, total cost of capital. There are a lot of people, Nathan Lacka is one of them. If you search total cost of capital, Nathan Lacka, you'll come across some links and some articles he's written to really try to demystify the different funding sources and kind of like the percent you're giving up. Because at the end of the day, if you raise $1 million today and you got to pay back, $10 million in a year, then you've given up a huge percentage of return. So the cost of capital isn't always based on equity, it's based on what you think the outcome's going to be. So even one of my clients raised $500,000 when they were starting. 15 years later, they paid that those early investors back because they bootstrapped the rest of that journey. They paid back those investors $15 million. So $500K to $15 million in a 15-year period is a large percentage, on an annualized basis. I think the number works out to 30 to 40%. So just understanding the cost of capital based on different outcomes and what you're trying to raise is really important to just run the numbers. If you want to exit the business and personally take home 25 million, 10 million, 5 million, whatever that number is for you, you need to look at the different funding options and what they're requiring, because they might ask too much equity to not allow you to get that outcome without aiming bigger and really adding a lot more complexity in your business model. And those are decisions we make earlier on to make sure that we don't make the wrong one and get locked into a certain path. Number 5, lock it in. So here's the deal. Evaluate the options, understand your unit economics, understand the different funding sources. But the moment that you decide that that's the path you're going, I need you to commit to it. I need you to execute against it. Too often, I see founders totally lose opportunities because they're trying to do 2 things at the same time. They're trying to continue to grow their business, show up for product meetings, manage the marketing team, etc., sales management, and at the same time, go close an incredible round of funding. Those 2 things are really tough to do at the same time. What I would suggest is you tell your team, I'm going to go down this path for the next 3 to 6 months. I'm going to be available, but at a reduced capacity. So I need you guys to really step up and lead these projects so that I can go execute and complete this really strategic, important thing to fund our next stage of growth. Okay, so to me, it's really important that you set that expectation. If you have co-founders, then it's a lot easier because you can kind of push a lot of that stuff on them. But you need to commit and execute against closing, and I call it #money in the bank. Until the money is in your bank account, there's no funding deal that is closed. Trust me, at the last hour, there could be a whole global meltdown and all these different options go away. So you need to make sure that you push, you drive, and get that money wired in your bank account and lock it in. So quick recap, how to evaluate funding options without giving up your business. Number 1, examine your exit. Number 2, map your growth engine. Number 3, evaluate options. 4, calculate the cost. And 5, lock it in. As I've mentioned a few times so far, if you want to download my funding options cheat sheet, you can click the link below to get a look at that. I break down the 6 different funding models that are traditional that a lot of people in the software space use, as well as list out the 11 different funding options for you and the different covenants and timeframes it might take you to raise or the amount of capital. So you can get a sense of effort and focus, but obviously dive into each one of those, work with your own legal team to make sure that if you get involved with one of these different options, and I don't mention any specific vendor or a company or service, I just wanted you to be aware of what those look like. So you can click the link below to download your copy. If you like this video, be sure to smash the like button, subscribe to my channel. If there's anybody you think that this video could support or serve, feel free to share it with them directly. As per usual, I want to challenge you to live a bigger life and a bigger business, and I'll see you next Monday.
The problem is I keep banging. All right, that's good. That's good.